Okay, welcome once again. My name is James Toby Samuel, and today we are looking at understanding divergence with pure price action. Now, before I move forward, let me try to explain to you that divergence is a concept that is popular among the indicator traders, but it has been in existence even before our technology of building indicators. It has been existing since the time of pure price action, support and resistance, and all of that. Okay, so and this concept is not a popular one, so you are really opportune to be able to have this knowledge I want to pass on to you today. So the concept of divergence is basically for reversals, and we can see that now a practical guide to spotting reversals without any indicators. Okay, so my name is James Toby Samuel once again. Thanks for coming. Okay, so let's know what divergence is. Divergence is a price behavior where the momentum of price weakens despite price continuing in direction. Now, let's say the price is buying, okay? Yeah, we are still seeing that the buyers are still in the market, but the momentum or the speed or the strength at which they are moving is very weak. Okay, so that is basically what divergence is all about. Divergence is when we begin to notice that okay, yes, this thing is going upward, and but the strength of the buyers are getting weak. Then we should be expecting a reversal at any level or a very near level that price is going to get to soon, and then to trigger what a reversal to the downward side. Okay, so no indicator needed. We identify divergence using only price structure, higher highs and higher lows. We use trend line, and we also look at them at a key level. Okay, so what's the major idea behind this? Price is moving, but with decreasing strength. That is the major idea behind divergence. Price is moving to a particular direction, either upside or downside, but with a decreasing strength. And it gives us a clue for possible what reversal. If you are seeing a weak momentum to the upward side, we are expecting a reversal to the downward side. If we are seeing a weak momentum to the downward side, we are expecting reversal to the upward side. Okay, so let's look at bullish reversal. Now, this is the condition of bullish reversal. Price keeps giving us what lower lows. Of course, the price is on a bearish move already, selling. It kept on giving us lower lows, but the next low is higher or forms a weaker push. Okay, now either the next low is higher than the previous low, or the weak is not that the distance between the previous low and the new low that we are seeing now is not much. It's just few distance. Normally when price is trending, the next higher high should be massive, at least moved more than 50 to 100 pips depending on the pair. But this time around, we are just seeing few pips distance between the last low. It's already telling us that the sellers are already getting weak, and then the buyers are likely going to come in. So sellers are losing momentum. That's what it is. That's are things that we look out for to see that yeah, this is what is happening in the market, and be able to read pure price action without any help of any indicator. Where it happens at or near a strong support zone. So when you now look at it now, these are the things I need to look. You are seeing already that that sellers are losing momentum. Then you also see that very near to a strong support zone. Okay, definitely you should be expecting a reversal to the upward side. Now, what is your expectation? Reversal to the upside. Okay, what are the tips? Do a trend line connecting the lows. Look for momentum. Slow down. Okay, basically that's what we should call it, a slow down. Okay, so I'm going to show you in the next video. This is just to give you an explanation of it. The next video will show you examples, clear examples of divergence. Okay, so let's look at the bearish divergence. Now, of course, let me go back a little. The bullish divergence means that the price is selling, and then we are expecting a bullish reversal to the upward side. And the bearish divergence means that the price is buying, and then we are expecting the sellers to come in, and then we sell. Okay, so what's the condition for it? That price makes higher highs. It keeps on giving us higher highs, but the next higher highs is lower. Okay, or it lacks momentum. Like I said, either the next higher highs is lower than the previous one, or it's the distance between the previous higher high and the new higher high is not that what, it's not that much. It explains that there's possible reversal, and most of the time this reversal is always massive. Okay, so what's the clue? Okay, buyers are losing what, strength, and then where it happens, we are looking at a bearish reversal at a what, a strong resistance level. Okay, other videos has explained to you how to identify resistance and support levels. Okay, So now what's the expectation? We are expecting price to move to the downward side. Okay, tips: connect the eyes with a trend line, look for fading bullish pressure. I'm going to show you examples of all of those things in the next video, but we need to get this information right. Now, key zones for divergence. Now, bullish divergence, you look at it at a what? At a support zone. Bearish divergence, you look at it at a resistance zone. Okay, so why it matters? Divergence only has meaning at key zones. Please, okay, not that you just go to 1 minute time frame and will be looking for divergence. Those things happens also in those time frames, but can you identify that, okay, this is a strong level at which is going to happen? Okay, so on key zones, on levels at which price has tested so many times, and it's showing you that yes, this level is where possibility of reversal is going to come in. Those are the levels that we want to look at it. Okay, without confluence, it's just a pullback. When there's no other confluence, okay, this is just a pullback. What are the confluences you can use? You can use trend line confluence, you can use chart pattern confluence, and all of that. Okay, so it's just a pullback, but not a reversal signal. Okay, so let's look at the next thing: how to spot divergence without indicator, step by step. And the first thing is what? Identify if price is trending, either it's upward or downward. Okay, you must have been seeing your higher highs and higher lows, and if it is downward, you must have been seeing your lower lows and lower highs. Okay, mark recent swing highs or lows. Okay, then connect at least 2 to 3 highs or lows with a trend line. Observe the next push. Okay, does it break previous higher highs or higher lows? Okay, with strength or weakening? Are you seeing weak around those areas? Are you seeing weakness? Of course, weakness is very easy to see when it comes to trading. Just study your candlestick and all of those things that we talked about candlestick before. Okay, is this at a key support or resistance zone? Those are the things that you should prepare yourself for. So then prepare for possible what? Reversal. Prepare for possible reversal. So let's look at the role of structure and momentum. Okay, structure tells the story. Okay, the story, the structure tells us that this is where price is going, where this is where price is leading to, is that it's buying or selling. Then momentum, okay, slowing. Okay, it shows us what? A shallow higher highs or higher lows. Okay, those are the things that you look at for. You have identified the structure, then you begin to look at momentum. Momentum is the next thing that gives us what? The shift in structure. Okay, watch for price selling or forming wicks. I've said that earlier. Okay, you begin to see wicks, you begin to see small candlestick in another area. It tells you that yes, there's weakness in that particular what position, especially when it comes to the higher time frame, like I've said. Okay, seen by comparing size of candlestick. I've said that earlier too. Okay, the candlesticks will begin to reduce in bodies. Okay, look for smaller bodies, rejection wicks. Okay, or failure to break levels. Those are the things that you look for, and then you begin to identify that yes, this is what is happening in the market clearly. Okay, it comes with practice and then identifying them or back testing. Chart patterns that confirm divergence. These are the chart patterns that work exactly like divergence. Okay, we have rising wedge, which is bearish towards divergence. Okay, price is rising, momentum is getting what? Weakening. I'm going to show you an example. I've talked about wedges before. There's a particular video I did on wedges alone. Okay, so but wedges are divergence in nature, because the price is rising, a rising wedge, price is rising, and then what? But the momentum is what? Is getting weak. So that's just it. Is a divergence, against, it is price against momentum. That's what divergence is all about. Okay, now falling wedge. Okay, bullish divergence. This is bullish divergence. Now price is falling, momentum is what? Is weakening. Okay, it's most of the time when you see this falling, rising wedge and falling wedge, the next move is going to be massive. Okay, but divergence in its whole do not only follow these two patterns. It can also not give this pattern, but yet it's still what divergence. That's why you need to understand it. I will give you an example of such in the next video. Now, these patterns are often leading structures before what? Reversals. They are giving us what? A structure before what? Reversals. Then in Elliott wave terms, they resemble ND diagonals. Okay, I've said that also earlier. They resemble ND diagonals. Those are the things that you need to look out for. Okay, so let's look at the next thing: how to trade divergence. Now, wait for confirmation. Okay, if it is bullish, okay, break above minor resistance. At least let it be a shift of structure. I enter based on that level. If I see other things on it, if the higher time frame is giving me trend line and all of that, I can enter that level. But for conservative entry, you can wait for a shift of structure. Okay, maybe on a very lower time frame like 4 hours or 2 hours, then you'll be able to see that okay, this is time for you to get in. Okay, so bearish break below minus support. Okay, so then when do we put our stop loss? Below the last swing low or swing high, below it. make sure below or above the swing high, below the swing low and above the swing high. I'm going to show you example how I did trade one this week. Now, what was the target? The nearest opposing structure or support and resistance, just the next low or the next high. That's where you are, if it's going to be if you are selling the next low in structure, and then if you are buying the next low high above that. Okay, entry tips: look for price compressions, wicks and pin bars. Look for rejections, look for mitigations. These are the things I do for, and these things you understand it, you know it very well, your analysis is going to be on point. Okay, so let's look at a conclusion. And divergence is a warning signal, not a trigger. It doesn't tell you that this is when you should get in. No, use other things as confidence to get in, but it warns you that yes, be careful to continue buying. If you are in a buy, you can leave that buy and then be looking for a possible reversal. That's what divergence tells you. Always combine it with support and resistance and chart behavior. I've said that earlier. Everything you are going to do, make sure you are getting in your price with a particular level, a strong level, and a level of what? Of interest. Okay, so use divergence to avoid chasing weak trend. So instead of you are seeing a trend and then price is playing around for so many times, instead of you still staying there, you can get out of that trade because it's already showing that there's possible reversal coming in. Okay, prepare for clean reversal. Okay, next thing we are going to be looking at is we look at analyzing real chart and practice spotting divergence. Okay, so see you in the next video where I will be explaining using the real chart. Thank you.